Hello, everyone who has just joined. So today we have a very special webinar because we have a very special guest. Ulrich Hoffmann will be giving priceless insights into AI and financial services. He has 35 years of professional experience in his professional career, and he performed various leadership positions. He is a member of board directors of UBS Business Solutions and AI Business Schools, as well as as an advisor to several startups.
Welcome everybody to today's session. I'm very pleased to talk to you about the topic of AI and financial services. As a challenging and provocative opening for our sessions, I would like to talk a little bit about the overall framework and industry development we are talking about, where AI in banking is a topic which we can then dig deeper afterwards, after that, so to say, keynote opening. What I'd like to share with you is a thinking which is generally happening in the banking industry, but also in the consultancy industry, where people feel where financial services will go into the future. What I'd like to do is talk a little bit about the developments in the financial service industry. What the two things are which fronting the financial service industry are two elements. One is the accelerating digitalization, and the other one is the emerging ecosystem world. Both of them will influence the banking scene as we speak, and the corona developments have even accelerated these two developments. Let me dig into that, starting from the overall profitability assessment, which a McKinsey study has done in 2017, in which they have updated recently, reinforcing the argument. If you look at the reality which existed in 2016, when they looked at the return on equity for an average bank, it stood at around 8.6, according to their analysis. And then, of course, you have positive developments in macro drivers, which drove up the development of the return of equity for the financial service industry. Of course, now being in front of the corona crisis, you might look at that a little bit differently, because banking is, of course, also addressed by the corona crisis, and therefore you will have a macroeconomic impact, which is now driving that to the downside. But it doesn't change the overall argument that macroeconomic drivers are the first element which you will look at if you look at the return on equity for an average. The next element, which is affecting the financial service industry, is pressure on margin. As many other industries, also the banking scene feels a pressure on margin, and that drives the profitability down. According to that assessment from McKinsey, it's quite considerable what they expect to happen for an average size of bank. There might be, of course, differences according to the banking scene geographically and also functionally, but overall, I think the argument is true that apart from the macroeconomic environment, you also have a pressure coming on banking to decreasing margins, which comes, of course, to new entrants which attack the banking scene. And, of course, also the fact that the macroeconomic environment doesn't allow positive interests according to the monetary policy which is in place globally. That is, of course, driven by a number of factors which I have laid out here. First of all, the effect of disintermediation, that banks and that the partners in the financial services environment start to deal directly with themselves, so the intermediary function becomes more and more difficult to defend. There is, of course, a commoditization effect playing in order to differentiate offerings and therefore also charge for value added. Then there is, of course, the invisibility. Banks, traditional banks, increasingly look more and more the same. Therefore, you also have that effect playing on the margin. And then ultimately, it's the unbundling of services, where new entrants try to attack certain product and services, certain parts of the value chain. And that altogether has a negative impact on margins, which I elaborated on before. Apart from the macroeconomic environment and the overall pressure on margins to the effects which I just mentioned, there's a positive impact. And that plays to the first element which I talked about digitalization, which is the increase in efficiency. So digitalization helps banks to address their platforms, their processes, and through that increase efficiency, which has a positive impact on their profit margin on their profitability, which is a positive impact. Of course, there's the last impact, which I wanted to talk about, which is the ecosystem development. I think generally starting from other industries and the digitalized devices, which are increasingly used vis-a-vis customers, starting from retail clusters, but also going to institutional customer scene, you have different elements which form the ecosystem from a client perspective. There are B2C marketplaces, there are B2B marketplaces, there are corporate services, there are wealth and protection. You see them on that picture. And those ecosystems increasingly change the vertical silos which used to be in financial services. If you look at that from a client perspective, where a retail client, if you put yourself in your personal shoes, you went to different partners in order to satisfy your needs, maybe in financial services, maybe in retail services, maybe in travel services, maybe in education. Now, increasingly, all these elements will be brought together by the new ecosystems emerging. And that, of course, has a double effect on banking. On the one hand, it's a challenging part by new entrants, but they can also play to the benefit of banks if they really move into that scene and really become an orchestrator and a participant of these ecosystems. And that, of course, open up new territory for banks, also address new areas of value added, which they can embrace. And that brings us to the next page, which McKinsey says that beyond banking, as you go beyond the scene of classical banking, there will be new areas opening up for banking, which also offers a new opportunity to raise the profitability. And therefore, if you look at that picture overall and think back to the slides which I showed you at the beginning, there are macroeconomic effects. They may be positive or negative. There's certainly a negative impact playing on margins. There's a positive impact to digitalization and the efficiency in banking. And then there can be an additional impact where banks have not yet really embarked upon, traditional banks, I mean, where they can really open up to new areas, new territories beyond banking, where new revenue sources might become available through that ecosystem environment. And therefore, back to my original thesis, through accelerated digitalization, pushing forward efficiency, and through embarking upon new territories by opening up and building new ecosystems, banks have indeed a fertile ground for the future. And that is in fact the area where AI comes into play. On one hand, as a facilitator to drive efficiency. So it helps banks to become more efficient providing their classical services. And on the other hand, AI helps them to build new territories, build new revenue sources as they embark into areas beyond banking. And these are, in fact, the two elements which I think should be the ground for our discussion for today, showing that AI is an enabler both to drive efficiency and build up new businesses. And then if you come from different industries, maybe healthcare, maybe retail, you probably come back to a common theme you also know from your industries, that ultimately digitalization and AI helps efficiency and helps building new business. And that in essence is what I wanted to share with you as an opening, that when we now talk about AI, we should think about two dimensions. The one dimension is the efficiency dimension, and the other one is the building new business dimension. So that's what I really wanted to share with you as a starting point, so that we, I think, now can go into the discussion, starting from your questions as there, but of course then also go into general questions which come from the audience. I think when we talk about fintech, I really would like to talk about financial technology and the financial technologies and the opportunity set which comes from it, less so the structure of fintech companies. If we talk about financial technology as a new dimension in financial services, I think there are 5 areas which I would like to mention here. And we can easily remember them by going through A, B, C, D, and E. A is agile. And you will see by the technology which I mentioned here, these are technologies which generally come through the technological development, and they are not unique for financial services, for fintech, but they are equally applicable also to health tech and edutech and so on. Agile working is the first one, a new way of operating these technologies offer a new opportunity really to go after process design, process implementation, which wasn't available with the classical technologies. So A is the first one for Agile. Number two is big data. Data is a driving force of the new big tech companies. In traditional financial service companies, data is abundantly available, but bankers normally did not derive their marketing, their decision making directly from data. I think that is a new trend which financial technologies give as an opportunity to bankers now. And of course, banks and financial service providers sit on a huge domain of data. Number three, C stands for cloud infrastructure. As we move to the cloud gives a new space of, so they say, opportunities to interact, to share data, also to increase the bandwidth of activities. Then the fourth one, D, is for digital platforms. We move over into virtual spaces to drive our businesses. We no longer operate only offline, we operate online. And we are no longer in analogous areas of interacting with clients through branches, but we use virtual spaces to do so. And the last piece, E, stands for ecosystems. As I mentioned in my speech, ecosystem is a new dimension which is opening up, and therefore, in summary, agile, big data, cloud, digital platforms, ecosystems. So all five, A, B, C, D, and E, make up the new trends in fintech. It goes across all areas of banking. If you look at the bank, you have in fact three areas, and this is again is typical also for other industries. First of all, client engagement, client interaction is one dimension where AI plays a role. First of all, figuring out what type of clients you can go after. So you can use AI to search the dimension to figure out new client segments, new clients. Then, so it's the client targeting piece. Then it goes down to the design of products which are suited for those clients. Then doing the advisory piece. So in all areas, in order to figure out what clients you would like to go after, then targeting and approaching them, and then also advising them as they have become clients. The whole client dimension is one area where I think AI opens up possibility. The second one is after the client interaction piece, it's the investment and trading piece. That's the product area of a bank. In the product area, likewise, as we do investment research, we do sentiment analysis, we design the investment strategy, we do trading. In all those areas, you can apply AI in order to support your search and decision making. And then the last one, where I have been mainly working in my last years, is the middle and back office. That's the operations area, where again, as you onboard clients, as you handle clients and monitor clients, as you monitor transactions, as you settle trades, as you settle payments, in all those areas, AI offers you also possibilities to become more efficient. So in total, across the whole value chain of client engagement, product and services, investment trading, and then middle and back office, in all those areas, banks apply AI nowadays. And then, of course, you have all the supporting functions. When it comes down to legal and compliance, contract design, contract screening, when it comes down to HR, recruiting people, monitoring people, and compensating people, when it comes down to finance and treasury, the whole treasury management, the accounting piece, but also the whole forecasting of profit and loss, and then the risk control with the whole area of scenario analysis, risk monitoring. So I just mentioned you a number of areas. So I think the whole dimension of banking along the value chain, but also in the supporting function, is full of opportunities for AI use cases. And in fact, as we speak, we see more and more of those use cases coming across all those areas. I would say, out of my global experience when I travel the world, I would certainly make a difference between Asia, Americas, and Europe. And I try to start with Asia first. Asia is the area which does not have legacy. Therefore, you do not have well-embedded financial services environments, including the regulatory enforcement. And therefore, tech companies like Alibaba and Tencent were able really to build up new ecosystems, which I was talking about, because there was no, so to say, standard incumbents, which, so to say, were there in order to defend their turf. And therefore, Asia is the one which moved most into that new digitalized ecosystem environment, which I see as a future. And therefore, those companies were able to embrace new opportunities. And traditional banks became part of those ecosystems, which were mainly orchestrated by these new big tech firms. So then I would say the Americas is the second one where you see most of those developments, because in Americas you have the big tech companies which made big inroads, also built ecosystems as classical banking environments where banking servers were already available. These in the Americas, you see most of those joint venture examples where classical banks partnered with new players in order to build these ecosystems. A very good example is Goldman Sachs partnering together with MasterCard and Apple to build new banking services. Therefore, it's not the big fintechs and big techs who started to build this ecosystem. It's more a joint venture route, but they were the second really embracing AI in a big. What is also true is in both areas, in the Americas and in Asia Pacific, you had big ecosystems because China and Americas are big economies, and therefore it's easier to build economies of scale. Europe is probably the last to come. It is the most protected area, the most, so to say, conservative area, the most fragmented area where you have the least impact. You also see it from a data perspective. Europe is probably the area where data privacy is most advanced and concerns about data sharing is the most advanced. Now, all these AI systems require big sets of data, and therefore Europe is probably the one which has the most to gain and the most challenges to overcome in order to develop in this digitalized ecosystem environment. But I would definitely say also in Europe, you see a number of players, classical banks, fintech companies, big tech companies, which now increasingly try to develop these type of new ecosystems also in Europe. I would say we should make a difference, back to my original thesis, which I did in my opening remarks, when it comes down to digitalization, meaning developing platforms, going after those new financial services, going after new ways of working. I would definitely say European banks have really developed well and have really fast-tracked over the last years. And of course, the Corona crisis has also facilitated this development quite a bit. You saw European banks really operating in a virtual space nearly to 100% vis-a-vis clients, vis-a-vis their own back offices when Corona forced the lockdown. So I would definitely say on the digitalization side, when it comes down to re-engineering processes and platforms, European banks are very much on that AI and digitalization path. When it comes down to the second question, to what extent have we become creative and innovative, creating new business opportunities, new ecosystems in order to develop new business opportunities? There, I would say European banking is pretty much still confined to that traditional turf where banks naturally operate. And there, I would say Europe has the most to step up in order to build new opportunities, in order to sort of say counter the trend on decreasing markets in their classical business. I would expect, if we talk about the long run, we will definitely see a amalgamation of three building blocks in the industry, leveraging the 5 fintech trends I've been speaking at the beginning, and AI in particular. On the one hand, you have the classical provider of financial services. They will defend their turf. The strong ones will not vanish. They will continue to play an important role. Also, the regulators and the central banks will make sure that these big classical financial institutions have their role to play. Then you have fintech companies, which I would describe as companies who are very specific and very, so to say, focused in their offering. I will mention, for example, providers like Revolut, like Monzo Bank in Europe, which came in with offerings for the small and medium enterprise, as well as retail clients. So you will have those people who are in the dimension of banking of the future. And then you will have the big tech companies who really try to build new ecosystems. And all three, I think, will have a role to play in the future, and you will see new ecosystems evolving. And the interesting piece will be to what extent a integration of different businesses will happen, as we have seen in the Amazon world and the Alibaba world, or to what extent this will be somehow hampered by regulators. But I think in the long run, in order to make banking attractive and be customer focused according to the needs of those customers, I would definitely see a further integration happening across the board of classical banks, big tech, and fintech. Automation and AI helps in order to manage compliance concerns and data privacy concerns. I think data privacy and compliance is a big topic in banking, especially in European banking. Banks are forced to follow the GDPR directive of the European Union. They also are forced by regulators to follow the compliance laws. And in order to do that, banks have their processes, they have their people in order to look after that, to ensure that data privacy requirements adhered to and compliance requirements are adhered to. And AI is a possibility which facilitate these, so to say, monitoring processes. And therefore, I would definitely say AI helps banks to become even more compliant and more efficient in being compliant according to those data privacy and compliance rules. So yes, clearly, especially in Europe, where data privacy and compliance is a big concern, you will see AI helping in following these rules. And you see it also with regard to the fintech companies, the new entrants, that they clearly have to follow data privacy and compliance. If they are not paying attention to these two areas, they will have trouble with the regulators and the central banks. Definitely a plus. I think AI, you need to imagine a big financial institution handles thousands, millions of transactions. And you have systems trying to monitor those transactions, and you have people trying to look at suspicious transactions. Now, AI gives you a huge opportunity in order to screen those activities on a different level. So what normally is done in banking is you now try to apply AI plus human intelligence side by side. AI gives you a great opportunity to do pre-screening in order to figure out suspicious transactions out of the millions of transactions big financial institutions transact each and every day. They also try to figure out transactions and client setups which somehow don't look right. And then it's the human being, which then is in a much more focused manner than in the past, can go after those identified suspicious transactions to go after that. Therefore, AI is definitely, or put it the other way around, fraud detection is a very good use case for AI in banking. It's a big challenge for incumbents, which makes life less easy than for the ones which come without any legacy. But I would say there is a good reason for legacy. There are certain areas where you can still apply legacy. And this challenging piece will that you need to re-engineer your systems as you move into the new world of digitalization and ecosystems in order to change your underlying. So you will still have your core, which has a good reason to be there. You can do your basic accounting on that basis, but you need to migrate those systems into the cloud. You need to change your core system to become compatible with a new way of technology development with microservices. You need to open up your space to be ready for open banking. So I think it's the re-engineering part, which is the challenging piece for classical financial institutions. But I would say, if we look at the leaders, they are very much pushing with their investment in order to change themselves from a classical legacy world into a brand new technology world. And on that journey, I would definitely say banks have made significant inroads. They are not yet there. It's a challenge, but I clearly I would say they are on their way of transforming themselves. And it's a challenge for them, but it's also an opportunity for them. And there you will see that will be probably also be a differentiation between the winners and the losers. Those who are really proactive and aggressive and bold, moving into the new dimension, embracing these new technologies in a proactive manner, they will be the winners. The ones which really try to cope with the new world with the classical legacy system will be the losers. I would again say the argument is not either or. From my perspective in banking, especially in banking areas, which is not only transaction handling, but which is advising people, I think you will need both. You will need artificial intelligence to do to give a basis for interaction and for investment analysis. So there are very good use cases in order to go after banking cases in development, in service delivery, but in client interaction. But ultimately, it will also need a human being in order to, so to say, advise clients, to give service to clients. If you put yourself into the shoes of a client who is looking for financial advice, yes, you would like to see, as I said, tools for interaction, which gives you a possibility to self-select and self-direct. But ultimately, you would like to get a human being also helping you in getting the right financial decisions. Therefore, I would say it is the future. I would foresee it's not either or. It is not big tech or classic banks. It is not AI or human intelligence. It's the combination of artificial intelligence and human intelligence. And these providers who make that best according to the client needs, which is the paradigm of the future. I would definitely say AI, robo advisor, is one application, is definitely a use case for that. I would definitely say so. But ultimately, again, for certain clients, especially in wealth management, and probably it also depends on your, so to say, intelligence, on your sophistication, but also on the, so to say, sophistication of the portfolio you try to manage. I think human intelligence will come into play. And therefore, for me, as a client, if I have to choose, I would definitely want to get certain tools where I can, so to say, get, so to say, artificial support in my decision making, but I would also like to see the human support. And that also goes down to other areas when it comes down to client service. There might be questions where I would like to talk to a computer, but at a certain point in time, there might be a question where I'd like to talk to a human being, either on the phone or in a branch. So I would definitely say it is not either or. And what you also see in other industries, look at Amazon, they're also not going for online only. They also try to build shops. They build the physical world. And I think the strength of those, of the future business models is the combination between artificial intelligence and human intelligence. I would definitely say now, if I look into the future, I would definitely say digital assets, tokenization of assets is a big topic, which will come into banking in one form or another. There were several attempts to do so. You saw Bitcoin, you saw Libra from Facebook. You see different attempts to get the digital assets undertaking. And therefore, I would say down the road, tokenization of assets is something. By the way, also for bankers is one of those elements of how you can grow the space of instruments you offer to clients. Imagine that through the tokenization, you no longer offer shares and bonds, but all of a sudden you also offer piece of art, you offer real estate, so you enlarge all of the opportunity set which you can offer to clients. Therefore, crypto and tokenization of assets is clearly something which is coming. Yet, two elements we need to be mindful of. Number one, the regulator, because there is certain, so to say, undefined risk as you go into that space. And I think banks, central banks and regulators increasingly try to embrace this new space. There are initiatives undergoing by the international community of central banks and regulators, somehow to give a framework for that, and that is still in development. People really would like to show that this space is well regulated as the classic financial service environment. So the regulator is one challenging part which we need to drag along. And secondly, the market players. We talk about crypto assets quite a bit and digitalization of assets, yet the real community, as they make financing and investment decisions, big corporations, wealth management clients, they're still operating in the classical world and not yet in the digitalized tokenized world. they buy their, so they make their investments in classical shares and classical bonds, and therefore the ecosystem, both from a client perspective and a regulator perspective, is not yet ready. But when I look down the road, for the reasons which I think the question was after, efficiency and new opportunities, I would definitely say that is a space which will develop. Yes, I see the challenge of the pandemic vis-a-vis global business models. We also built our offices around the globe, and all of a sudden through the lockdown, you could no longer operate. I think it will trigger a reconsideration to what extent you can become even more efficient and use AI and other technologies in order to attack the physical space. And it will also trigger a question to what extent you might eventually take back certain activities which you offloaded to other parts of the world or to your supplier. So value chains and international delivery frameworks will come under scrutiny. But my belief is, yes, there is a challenge to drive your business models to the next level, but will it be a fundamental back to the roots? No. I clearly feel the globalized environment we are operating will not vanish. On the contrary, it will stay, but it will see a redefinition of tasks which you do in-house and which you do with partners, tasks which you do close to your clients, and tasks which you might eventually do in service centers which are remote from your clients. So I think, coming back to my original statement, what we will see, and AI is a big facilitator driving business models to the next level, both from an efficiency perspective, but also from a revenue opportunity perspective.
Okay, well, that was all our questions, and I really want to thank you for very detailed answers, and thank you for spending your evening with us. I'm sure it was really informative for all of us, especially I am very interested in financial services and finance itself. So that was great. Thank you for being with us.
Thank you.
Okay.
Have a good evening. Thank you.